welcome to TheoTrade. This is Don Kaufman. February 19th, 2021, doing the TheoTrade weekend update here on a Friday afternoon. Well, this evening we're going to be talking a little bit about the Great Gamma Unwind, possibly coming to a theater near you very, very soon. I'll actually explain in a bit more detail what that breaks down to. Before I really get into a little bit about Gamma, some of the Gamma Unwind, we'll talk briefly about the markets in general, which, well, for the most part, the last 2 weeks, massively unchanged marketplace. I mean, what you're looking at on the screen right now, and I'll just highlight kind of where we were when I said we're massively unchanged 2 weeks in a row. For the most part, that was 2 weeks ago. This is where we currently are. I mean, we've moved from roughly 38.80 to roughly 39 and change. Again, a very, very mild overall movement. And if you are positive theta right now, which I absolutely I am. I'm positive theta, which means I'm been selling quite a bit of premium lately with the higher volatility, but more appropriately, much higher skew. But if you're positive theta, you're doing well. Again, we're just marking time, moving sideways. But again, the dynamics of the marketplace, okay, are kind of ever changing. And the first dynamic that I want to bring to you before I get to the Gamma Unwind, I want to talk a little bit about the bond market in general. The bond market's actually going to tie into, the Russell. It's going to tie into, of course, the financials, but also the bond market and the dynamics in the bond market do tie into what I kind of term the Great Gamma Unwind. And again, the possibility of that coming to us sooner rather than later. So let's talk about, to begin, the dynamics of dramatically rising interest rates. And to start with that is, of course, we're going to go to the bond market. I mean, the bond market continues to see a fairly incredible slide to the downside. I mean, it's just a few weeks ago, we're actually trading the 170 handle inside of the bond product. And here we are in the, the low 160s. Now, listen, I get it. Not everybody necessarily trades in bonds. I mean, bonds, what is this? 163 and 6 ticks. Some people don't even know how to quote bonds. So, and that's all right. By the way, bonds, they're just, they're still broken into fractions, like the old Spanish galleon time. So bonds are still trading in fractions. There's 32 ticks to a 1 point move. Nevertheless, to put, bonds into a bit more context, or shall we say notes into a bit more context, I like to talk a little bit more about, the relationship between, for instance, notes selling off and interest rates going higher. In this case, we're looking at notes. So one of the first things to delineate is the difference between bonds and notes, okay? The notes, it's the 10-year. And that's the 10-year U.S. Treasury futures. And then when you're looking at bonds, okay, this is the 30-year U.S. Treasury. And it's a futures contract, all right? It's just representative of like the 30-year. Now, most of your big institutions, they'll be trading, all right, the notes. And in fact, if you look at the volume of the notes, the last couple of trading sessions, we're just about to come into a roll, but the volume is huge by huge, people. If you look at the, the volume of the bonds, maybe not quite as big, because the notes, again, are a much more institutional level product. The bonds are a little bit more, I mean, they're still institution, but there's a lot more retail trading in there. And this is, it's alarming to say the least. And, how else do I present it other than to look specifically at the interest rate associated with the ZN, and that is the TNX. Now, the TNX, this is not a tradable product. This is just the interest rate component and the interest rate associated with the 10-year. I mean, this is the stuff like, pretty much everything you do in your day-to-day life is actually based on mortgages and so forth. And I mean, basically, when you look at this and you're like, it's not 9%. No. Okay. What that means is 0.9%. Right now, where are we? Yeah. Today, we're all the way back to 1.345%. Now, this is just since the beginning of the year. We've moved from 0.9% to, 1.345. And you're like, well, okay. So, listen, this is rates exploding. And again, to kind of put this into context, all right, in percentage terms, just how far has this 10-year rate gone year to date? I'm just going to click year to date and you're going to see. This is again that 0.9%. Now we're that again that 1.35%. But yeah, that is just shy of 50% increase in the again in the 10-year interest rates. Now, has it actually hindered some of the markets that you would think about in this context? Like again, has it hindered them? You look at stuff like XHB. All right, this is home builders. Hasn't hindered that at all. Okay, but then you start thinking things like, well, what about the financials? Well, the financials got to be doing what? Fantastic, which they absolutely are. But this is where we're starting to look at, and what we're going to hit here is kind of a critical juncture, and I'm going to talk about that here momentarily. But let me give you again some of the dynamic of this and some of the background. Is that financials and financial products? If you have like a JP Morgan, of Bank of America, they love what? Higher rates. They're going to like higher interest rates, and the higher the interest rate goes, what do you think happens to the financials? Well, they get to make more money off of your money. Okay, banks, brokers, pretty much anybody who has their hands on your money is going to make more off of your money. All right, when the interest rates start to go up. So again, when you saw that dramatic rise, as I just showed you a moment ago, inside of the 10-year, okay, and you see the financials, of course, ripping with it, but this dynamic can really start to break down based on the velocity of the move inside of these rates. And the velocity of this move is becoming just downright scary at this point. So what we actually have right now is, of course, yield curve, and it's steepening a little bit. And that the yield curve, don't let that intimidate you. That's just looking at like the 10-year versus the 30-year, maybe through the 5-year in there. Okay. And again, rates are just exploding higher. That's the bottom line. But you start to think about interest rates exploding higher, and you're like, okay, so the financials, they're going to do really, really well. They're going to do really, really well. The financials, yeah, they'll do well. What's going to happen to some major stocks out there? Maybe not as well. Companies like Tesla that are still basically like pretty much junk bonds. The interest rates that they're carrying over here, they're going up. And you're not actually seeing it impede upon too many individual stocks at this point. Again, we went and looked at like some home builders. It's not impeding upon them. I mean, I'm looking everywhere right now. Is it impeding upon anything? Okay. Take even a look at something that pays big dividends like XLU. All right. You got me here. All right. The utility sector. So the utility sector pays about 3.4% in dividend yield. It actually is coming down just a little bit as the 10-year goes up. But net, there's not much going on. So here's one of the dynamics I really want to bring to you. And that's simply this. If these bonds continue to see, all right, some wild sell side activity, all right, this should not only hinder, but almost like snap the back of the financials. Okay. And moreover, if you don't even look at it that way, I'll give you a completely different take. So again, if the bonds continue to sell off and sell off hard, I'm like, oh, it's going to break the back of the financials, right? Because interest rates kind of a double-edged sword. They go up, it's great for the financials. They explode up, it could be absolutely devastating for the financials. All right, but we'll push that aside for a second. How about this one? If bonds continue to sell off, it's just going to completely stall out the economy. Right? This is where the Fed would possibly have to step in and go, whoa, cowboy. Let's not let these rates get out of control. And that's when they have to put in what's called YCC, which is yield curve control, which I'll tell you right now, okay, these bonds continue to sell off. You're going to be hearing about YCC, yield curve control, coming to a theater near you, again, sooner rather than later. And that's always a possibility. But if, again, the bonds continue to sell off, interest rates are going to explode higher. Interest rates explode higher, it'll start to actually pull down the S&Ps. You did see a little bit of stall in the marketplace because everybody right now is watching the bonds. But here's actually the kicker. What will ultimately happen is it'll start to cause some sell-side activity inside of the broader marketplace. And as it causes sell-side activity in the broader marketplace, all right, what we'll actually get is things like statistical arbitrage. And what StatArb will do, instead of selling, for instance, just 60 stocks, it'll actually whack all 100, okay? And that will break the back of the financials. So again, this is a very, very fine line that we're actually walking on right now, looking at the bonds selling off and selling off dramatically. And I'll give you another one over here because there's not too many places these bonds can go right now, okay, that are not going to dramatically influence from this point forward, okay, these S&Ps. So if the bonds continue to sell off and sell off hard, it's going to hurt, and it's really going to hurt technology, okay? And eventually that would spill over into the entire marketplace. You'd see some big sell-side activity. Again, that's if the bonds continue to sell off, especially at the velocity they have been, all right? If bonds turn around and start to rally, well, if bonds start to rally, that's actually going to hurt the financials. That's absolutely going to hurt the financials, which could spill over into the S&Ps and take down the rest of the marketplace as well, okay? But then, if the bonds were actually to kind of mellow out, sell off, maybe just very, very minimally or just completely mellow out at this point, then and only then would you actually see the S&Ps probably be just fine at this point in time. But again, it is a very, very, okay, slippery little dynamic that we're in right now. It's kind of what I call like a critical juncture, all right? Movement in the bonds can cause, again, as I just said, big sell-off in the bonds. It's going to impact the S&Ps and is eventually going to snap the back of those financials. But if you rally back up in the bonds, then you're taking interest rates lower, which is going to impede upon the financials. I cannot find too many scenarios where I can be bullish on the financials moving forward. And again, I am taking a number, okay, of bearish positions inside of the financials, including, short a few thousand shares of the XLF and in a couple of different ways and shapes and forms. All right. So how does that actually relate to what I call the great gamma unwind? Well, there's one aspect that people really have to recognize about markets. Okay, structurally speaking, markets are vastly different than they were, okay, a couple of years ago. And that has a lot to do with what I kind of term a little Dodd Frank with a side order of Volcker Rule. One of the things that most people don't recognize in the marketplaces is your big banking firms and anybody that was labeled all the way back in the financial crisis. If you were labeled too big to fail, okay, then they really applied the Dodd Frank rule specifically to you. And within that, by the way, within Dodd Frank, there's actually the Volcker Rule, and that actually deals with proprietary trading of a lot of the major banks. So you're like, how does that influence the S&Ps? Who cares, right? Coming into the financial crisis, firms like Bank of America and JP Morgan, they had huge trading divisions, like Bear Stearns. Oh yeah, you remember them? They had huge trading divisions, and they would take, okay, substantial bias in the overall marketplace, right? Like it used to be. But no, not anymore. Most of them, all right, adhered very, very quickly to the Dodd Frank, and again, specifically the Volcker Rule. Before the Volcker Rule even was going to be enforced, most of the banks came into alignment with it, which means they became what we term bona fide hedgers. Okay, and what bona fide hedging basically means are like, market making, right? They don't take any directional risk. Most of these are, roughly speaking, delta neutral. And bona fide means it's just, they're doing their best. That's, whenever you look up the term, like if you looked up like bona fide hedger and you actually looked it up, it'd be like, well, that kind of means that we're doing our best to be as neutral as we possibly can. They're neutral, okay, for the most part, which means that the big banks and so forth, they're not taking, okay, substantial directional bias in any, okay, index being stuff like the SPX, stuff like, obviously the SPY. So they're not in the S&P 500. They're not in any S&P 500 stocks getting long, getting short, okay? They are taking, and most of these banks are taking dramatic positions. Again, depending upon who's the market maker out there, they are taking dramatic positions. But net, okay, their delta is very, very close, okay, to zero. However, what this effectively does is it causes a incredible gamma dynamic. And this is what's often missed. And it's something that, I've talked a lot about gamma squeezes. And, the term gamma squeeze, I'll tell you what, if somebody had said that, like 10 years ago, I'd have laughed. I'd have laughed because, the only one who actually even knew what a gamma squeeze was, some of the market making firms and so forth. And again, I spent, 15 years in the brokerage industry, some years in the, before that, working at a trading firm. But, the term gamma squeeze, all of a sudden, in just like the last couple of weeks, has become like, the in term. Oh man, yeah, I got in that gamma squeeze. Okay. But the gamma squeezes, you just point a finger right here. It's Dodd Frank. All right, and the Dodd Frank, and again, this is something that I've talked to a couple of our clientele recently about on email. When you look at the dynamic of a marketplace and you see stuff like, and again, the reason the spiders are up here, when you see stuff like that, what is that? It's almost a perfect straight line. Okay, this is not necessarily retail clients. They're like, I am buying, I am buying, I am buying, I am buying. You're like, this thing's like a robot. It is like a robot because it is. It's bona fide hedging, all right? And this is the dynamic of it. Effectively, what you have, and I'll use this example for you, okay? You have lots of retail traders right now, okay? And here's the exact example that I think will really resonate with most people. You have a lot of retail traders, okay, that are just joining the marketplace, and those retail traders go out there and they love, okay, to buy calls. This is an example I've given so many times. So they buy calls. And when you buy calls, who sells you the calls? Okay. Let's call it a market making firm. Let's call it Citadel. Can I mention Citadel right now? Can I? All right. Everybody knows the name. I mean, come on. They just testified yesterday. Somebody like Citadel will come in there and they will sell calls to you. But when you buy calls, what are you really doing? All right. What are you really doing? I'll tell you exactly what you're doing. All right, you're making yourself positive delta. But that would then in turn make Citadel negative delta. Citadel doesn't want to be negative delta. Why don't they want to be negative delta? What? They don't want to take all your garbage directional risk. What happens if the marketplace goes up? Citadel will get absolutely killed. So what do? Okay, they sell calls and then they hedge, right? And they operate like what? Market neutral, right? And they operate with the dynamics of the marketplace. So what happens is, the moment you go out there and buy calls, they sell you the calls and it makes them negative delta. Then they turn around again and they'll do things like buy stock. Okay, they'll buy stock. Why are they going to buy stock? Because that actually will give them positive delta. What do? They zero out their delta. But then what happens is some other monkey comes in here and buys calls. And when they buy calls, you know what happens? This little equation of zero, it's not zero anymore. It becomes a little bit more negative again. So what do? They have to buy more stock. Okay, so they buy more stock. And then you start to get these linear type moves. And this is kind of what we term a little bit of like a gamma squeeze, right? So the more calls that are bought, right, the more stock that has to be bought. The more calls that you buy, the more stock that has to be what? Bought. Why? Because you're trying to trade with the dynamic of the marketplace. That's what the market neutral, okay, and the market maker has to do, is trade with the dynamic of the marketplace. We start to spiral higher and higher and higher. Now, relate this back to the bonds. The bonds are getting scary right now. Interest rates are going up. Think about, okay, the opposing. The one thing that's often missed, especially lately, is that the thought is that gamma squeezes only typically happen, if you will, to the upside. And this is, the S&Ps, and take a look at the IWM. It's the great gamma squeeze inside of the IWM. Okay? Can you imagine the opposing dynamic? Have you seen the opposing dynamic? You absolutely unequivocally have. All right? And the dynamic looks a whole lot like this. Okay? But I'll tell you what, when you start to pull up, charts for a much more substantial period of time. Let's pull up like 15 years in here. And you start to look at this and think to yourself like, well, apparently it just, the market only goes up. Some guy told me that on Twitter. The market only goes up. Until it doesn't. Until we actually have, okay, what we would term, I would term, the great gamma unwind, where ultimately, all right, all of the leverage starts to actually invert and literally starts to spiral us. I believe some of the trade action that we're seeing of the bonds right now is absolutely pivotal. And it's critical, okay, at this point. The bonds better either mellow out or reverse course back up, okay? And we're going to see just this, the great gamma unwind, all right? The sell side activity in the bonds right now. And so why am I pointing out the bonds so much? Because the bond market, right, is not covered by Dodd Frank. The big banks are absolutely unequivocally taking positions and directionally biased positions inside of the Treasury products. So you have to love this. The Dodd Frank bill says you can't take directional positions in the S&Ps, okay? And if they can't take directional positions in the S&Ps, it changes the entire nature of the S&Ps. right? It just changes the nature. Like markets are not going to function like they used to. But by the way, all the big banks, yeah, they can take directional positions inside of any of the bonds, the notes. You start to look at this and you're like, holy crap, that doesn't look like a bond product over the last 3 years. The bonds don't even look like bonds. The bonds look more like the S&Ps, okay? And again, this is why I think that what's going on inside of the bond market is inadvertently going to start to bleed over inside of the S&Ps. And as I said, this could happen in very, very short order, what I term the Great Gamma Unwind. Last but not least on this weekend's update, I want to talk a little bit about the SPX, the expected move. The expected move has expanded out. So the expected move for this next week of trade, we're looking at about $74. So that's approximately $74 higher or $74 lower, effectively taking us just a hop, skip, and a jump away from like 4,000 side of the S&Ps. But again, not too critical. When I look at this and I say it's $74 move, listen. This past week, we only had a 4-day trading week. We had about a $57 expected move. We hit every ounce of that $57 expected move. This coming week, once again, I would actually expect some rip-roaring volatility to hit the marketplace. I recognize that we have been massively unchanged over the last 2 weeks, okay? I would not be looking for that to happen again, right? You got some risk on, again, start to think about overall delta risk. This doesn't mean that the Great Gamma Unwind is like upon us tomorrow, but the dynamic in the bonds is absolutely pointing to this starting to spill over into the S&Ps. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.